We constructed the forum with Tim Mueller as our lead speaker to present an insider's view on the dynamics at play within the IT services M&A market. As CEO of IT ExchangeNet, Tim is actively involved with both buyers and sellers within the space, and we are confident he will share unique aspects, unique insights based on his hands-on experience. Tim himself, and being very brief, his bio highlights are before you. But Tim has a very impressive list of successful entrepreneurial startups. These led him to his past selection as the Entrepreneur of the Year by a joint USA Today, NASDAQ, EY award. Tim, we are very glad to welcome you, and we will leave it to you to better introduce yourself and your firm. Thank you, Tim.
Rob and Amr, thank you very much, and it's good to be with you all and with this esteemed group of executives in the IT space. As a brief introduction, ITX, we've been around for a little bit more than 20 years. My business partner and I have completed over 175 transactions in this space. Our focus, particularly for this discussion, is the middle market space, doing transactions typically less than 35 million US in transaction value. So we really like working with the entrepreneurs in finding buyers that are in that kind of middle market and even upper middle market space who are looking to grow by acquisition. And so our role really is bringing buyers and sellers together. And we really only focusing on the IT services space. That includes managed services, cybersecurity, your typical IT services firm, and then really go deeply into the Microsoft, Oracle, and Salesforce ecosystems. So I think what we're talking about today is something that we do keep our finger on the pulse with, and happy to share what we've learned in this kind of pre-COVID and now COVID space and how it's affected M&A.
Great. Thanks, Tim. I'll maybe kick us off with a first question on private equity. There's close to $2 trillion in dry powder that still needs to be deployed. In your experience, Tim, what do private equity firms look for in the IT services space? And do the way, I guess, they approach valuation, does it differ from a strategic buyer?
Yeah, it's a great question. And I think we have to start off by saying that, according to PitchBook, we've seen that add-on acquisitions really account for 68% of all private equity buyouts in 2019. And we assume that that's going to be the same in 2020 and probably 2021. So first and foremost, as the private equity firms are looking to make acquisitions, we don't see them standing still ever. We see them take a platform business that they feel they could build around or layer business underneath them. And those platform companies typically are in that kind of $20 to $50 million range to begin with, and then being able to add on some additional $5, $10, $15 million firms to start getting into that larger $50 to $100 million range in revenue. So they look for businesses, particularly CEOs, that could be team players. They want to make sure that, after driving the bus for so long, they could be a very good and capable bus rider. In some cases, they're looking for the CEO to really take over the entire platform build. And so those are important areas on the talent side, but also on the service providing side. Some of the hottest areas that a lot of the private equity firms in our space are looking at are MSSPs, which are the managed security service providers. They're doing cybersecurity offerings. Your managed service providers, MSPs, that are also, in that space, but perhaps are doing more of the hands-on, bringing in technical folks and CTOs and to do a lot of the work inside. The big two most seductive words I think you'd see in most of these acquisitions are recurring revenue. Those two words really kind of drive a lot of what the private equity firms are looking to build off of for the obvious reasons. If you've got 70 to 90% recurring revenue and they're all tied into 1, 2, 3 year contracts, it mitigates a lot of the risk for the private equity firms that once they make the acquisition, they're not seeing now customers walking off and now the business is now devalued in the period of a year. And I think the other part that private equity firms are looking at very closely is, what are the entrepreneurs or the founders' goals? Are they looking to retire and hand over the keys? Well, that's a different play altogether because now you're parachuting the management team in or taking over. Or are they looking to really advance themselves in the family photo of that platform? So, younger CEOs, a lot of gas left in their tank, and they want to do something that they themselves can take advantage of the accretive value of the built-in company, that over 2, 3, 5 years, they're able to take a second bite at the apple and enjoy a much greater exit the second time around.
Thanks, Tim. I want to go a little bit further into the velocity of consolidation within the IT services. What do you see driving the pace? Do you see it as sustainable? You made reference to seductive and security, but perhaps what do you see as unseductive, but where there may be a contrarian's opportunity?
Yeah, so the velocity, we see that continuing well into 2021 and beyond. A big part of it is that the owners, the shareholders of these IT services companies are demanding more than just organic growth. So they're seeing that it's either you need to acquire or be acquired at this point. Just normal organic growth, year-on-year growth of 10, 15% doesn't do it any longer. And so these larger, and when I say larger in the mid-market, it could be a $75 million revenue company, it could be a $500 million company, or it could be some of the larger players like KPMG, Accenture, who we've seen, particularly during COVID, are swimming downstream and looking at assets that they would normally not have been seeking to acquire. But because of the lack of deals that are in that $200 million range at this period, and also, again, about risk mitigation, they acquire a smaller business. They're able to achieve their 2020 objectives or 2021 objectives for M&A. Number two, they mitigate their risk because it's not as big of an acquisition. Number three, they're able then to cross-pollinate or to sell into the customer base of the acquired business. So we see some of those larger players coming down into that mid and smaller mid-market space. In addition to that, the velocity continues because I think the decision-making on the founders is changing. We have a lot of, not hundreds, but thousands of businesses out there that are owned by baby boomers. And so purely by father time, they're starting to feel as though they want to unlock the value of the business. And we spoke with numerous owners that are in that kind of 60 to 70-year-old range that are going into 2020. They were very excited about selling, and then COVID hit. And I think it really jarred them that they didn't go to market and didn't try to unlock that value. So there is quite a bit of sellers out there that are helping that velocity continue. So when you've got the amount of private equity capital and even strategic money, and you've got the number of sellers that are looking to exit from their business, it really becomes a very positive, perfect storm.
Great. Tim, in your intro, you touched briefly on COVID. Can you expand on how COVID has affected the mid-market space, specifically when it relates to M&A, private equity investments, valuation levels, and just general deal flow?
Yeah, first, like everybody else, March, April of 2020, we didn't know what to expect. None of us had gone through a worldwide pandemic before and how it affected M&A. But by the May, June timeframe, we saw that the businesses that were continuing to show that they could power through this, that not only their current monthly revenue, but also their projections of pipeline to get through 2020 were going to be strong. And that encouraged the buyers to say, you know what, we want to continue with this. The money didn't go away. It was just the decision-making started getting a little bit more, I think, pensive at first. But then by the time the summer hit, we saw deal flow just continuing like it did 2019, at least in our space, that smaller mid-market, whereas this will be a record year for us. We think that still a very strong year for acquisitions. Now, the other businesses that did get negatively affected by this, by the COVID pandemic, unfortunately, they were labeled as distressed businesses and businesses that were likely to get a discount if they continued on with the M&A process. So we've seen quite a few people hit the pause button and say, we're better than this, and we know that we can get a better valuation, and this is just a blip in our revenue pushback. So they'd rather wait until 2021, mid or whatever it might be, 21, to re-engage and go back out to the marketplace. And both strategies work, but for those who really did, survive and thrive, through 2020, were able to continue down with their valuations and have a good exit. As far as valuations and how it was being hit, one of the things that we had seen, and we've got 3 more deals that are going to close before the end of the year, is that valuations, big picture, let's call it transaction value that includes an earnout, any kind of tail that's involved in it, we have not seen that decrease. What we have seen is less money cash at close. So again, put yourself in the buyer's shoes. They want to try to mitigate their risk. They don't know what 2021 might be ahead. So instead of some of the normal 65 to 70% cash at close, maybe 80% cash at close, it's probably in the mid 60s up to 70%. And the rest then is tied to milestones over the next 18, 24, maybe even 36 months that are tied to the success of that integrated company into the acquired ecosystem.
Thanks, Tim. And perhaps going a little bit further into the practical realities of COVID-19, how have you seen people deal with the challenge of face-to-face? It used to be a big part of the due diligence process. Can you say how they've addressed this and whether you see face-to-face starting up again?
Yeah, purely by this virtual conference we're having today, I think there's been a tectonic shift, if you will, among people getting used to speaking through a lens and a screen and getting to know each other. We're witnessing that with many of our children that are going through the educational process online, all the way to how do you best keep a company's culture together, and a lot of it's online. And now in our space, the typical acquisition would be, have a couple of calls by phone, do a little bit of data exchange, and then a team of buyers would then fly into the seller's city, have a nice dinner, spend a day together, and really look at each other in the eye across the table and get to know each other, so that they're not only the analytics work out, but what does the gut feel say about making an acquisition. And so most all of our acquisitions have taken place through the camera, instead of the flying. We saw probably in that late summer, early September, October range, people were jumping on a plane and going to see the sellers in their home city. A lot easier, particularly if it's East Coast and they're able to take a car and make a 3 or 4 or even 6 hour drive to go meet with the buyers and be COVID safe. But now with this new, I think, push, I think a lot more of the buyers have gotten a little bit more tentative about jumping on a plane now going into the holiday season. So I think just purely by the fact of trying to be safe, people have made it work, and they've used Zoom, Teams, or whatever it might be to get the work done, to get to know each other by video.
Okay, that's great. Maybe one final one for me. Looking ahead, when we're thinking about 2021, can you speak to the supply and demand for M&A deals in the mid-market space specifically? Then when thinking about the results of the presidential elections in the US, any impact there on IT services and the tech space in general?
Yeah, so going into 2021, we're bullish in this mid-market and small mid-market space that the supply and the demand will remain very high. You've got Mike from Quisitive is on the line, among others that are going to speak today, and their whole mantra is let's continue to be strong in our organic growth, but it's very, very key in order to get acquisitions done in order to achieve their long-term objectives. So we still really believe, and the numbers are there to show that supply and demand. I'll harken back to my comment a few minutes ago, a lot of the baby boomer owners, but you also have a lot of people in their 40s who looked in the mirror and said, hey, I've gotten it to 15 or 20 million, and I'm just not the person to get it to a higher revenue target. And the fact is, I really don't want to do HR, tax planning. I really don't want to figure out the operational side. I'm here to grow a business. And so to meld into a much larger ecosystem and allow them to unleash their talents and maybe leverage the marketing muscle of a bigger buyer and such allows them to really achieve their professional objectives. We see that continuing just as it was in 2018 and 2019. The one thing I will make a point about, your question about the presidential election is that, still to be determined on the 2 seats in Georgia, but it's clear that the Biden administration is seeking to make some tax changes. And one of those is capital gains tax that allowed up to this point sellers to enjoy a 20% capital gains on their sale of their business. And if that does go away, you may be adding another 15, 17 points to that, which, again, makes it a lot more difficult to take the bite on the tax to assume that type of change. So sellers are going to have to do the math and figure out whether or not if those tax changes go into effect, if it's still worth selling at this point, or they ride it out and see what happens 4 years later or beyond. But the fact of the matter is, at least at this point, it's still going to take a lot to get the taxes changed. And at this point, it's still that 20% capital gains. Overall, we'll see how the markets respond to the Biden administration coming in and some of the other policies that they make, and whether or not that does change through the IT services side. But what is going for us is that this is still a very transitional stage for companies that are doing the transformation to a true digital business. And to do that, IT services is the key element of getting that done. And with that, we do see consolidation continuing.
Very good. Thank you, Tim. We thank you for giving us a flavor of your views, and we very much look forward to diving deeper at the end when we get to the broader panel. So thank
Great.
you, and we will be following up.